So if you go to the homepage, there's a link on the lower right side, financing green growth with capital ownership opportunities for every citizen. The first slide is just so you see all the major elements within this monetary system that we're proposing and the interrelationships. And so what I'm going to do is go through each of these various steps one by one, and I'll open it up to questions one by one. Okay, so as Norm was saying, there's a process by which we determine how much capital credit is going to be made available each year. And so each year, annually, biannually, or quarterly, the government will estimate how much productive capital will be added to the economy in the coming period, both in the private and public sectors. And this could be the government, it might be the central bank or some other body that makes that estimate based on what businesses say they're going to need. So dividing that number of projected total capital formation financing needed by the number of US citizens and all eligible participants, that would give us a number which is for each citizen, how much capital credit, interest-free capital credit, are they entitled to receive if they can find, match it up with the sale of shares that are qualified. And so we give an example here of the about 4 trillion and then the 2018 population. So both of those numbers are larger. So what resulted was about $12,000. And we decided to simplify this so that if you go to there's another link on the homepage, which shows the projected accumulations throughout a person's lifetime. And that's keeping very conservative projections, not taking into account that the economy will probably grow as you have more customers with money. So, but this was just to give people an idea of how much through this capital ownership account they could accumulate over their lifetime. So here, the first step, as we said, was the periodic calculation of capital credit, whether this is the government or the central bank or another official body. And so it will determine how much each of us through our capital ownership account are entitled to receive in terms of newly created interest-free capital credit. So the next step is that, and the timing of these steps, we have to, maybe clarify that everything is determined by the need of the enterprise wanting to grow. So for purposes of this diagram, the enterprise that needs to finance its new capital assets will decide that it's going to do so by selling newly issued shares to the citizens at the current market price. There's a benefit to doing this in that the enterprise will escape paying corporate income taxes on all the full dividend payout voting shares that it sells. So any future dividends that are not used to repay the capital ownership loan would be paid out as personal income and taxable at the personal individual level. So if we take a family of 4, they would go to their local bank to set up 4 individual tax sheltered capital ownership accounts. And so knowing that the children are not going to be qualified to make investment decisions, the parents would be making those decisions on the behalf of their children, and the parents could have professional assistance in determining what the best investment for their particular circumstances are. So they get advice. This could even be from the bank where you set up your accounts. And the account will be what receives the annual capital credit allotments. Okay, so here we see the second step is that here you have the corporation wants to do a green growth project, and the way it's going to get its money to acquire all these the assets it needs, it's going to sell shares to the capital ownership account, which is set up probably in one of the commercial banks. Step 3 is the enterprise, when it takes the money, it's going to get money, and the that new money is essentially, it's the counterpart of the capital credit. So it's capital credit to the borrower, this citizen, through their ownership account. But the enterprise needs some kind of the money in the form that can go out and buy whatever plant and equipment or whatever it needs. So as it generates profits from using that new capital, it pays out each year a certain amount that goes to the capital ownership account, and that is going to be channeled back to the lender. Okay, so saying here, it guarantees, it promises to pay out all of its profits. These have to be full dividend payout per share, and that's going to be going. It's guaranteed. This is the guarantee that is made to the lender, the bank. Okay, then the family is going to present bills of exchange, and Mike is going to explain this in a little bit more detail. This is where it starts to get kind of technical about how these are done, but the bill of exchange it's essentially a promise that the credit will be used to purchase these profit-making shares, and that the profit will be used to, there'll be also corresponding what's called a promissory note that the borrower promises to pay so much back to the bank.
Why don't you
So
give you lift that
oh, sure.
diagram so people can see the full diagram, right?
Okay, sure. So here it's going to present this bill of exchange. It's a promise. Okay, and it's how it connects the capital ownership account to the lender, the commercial bank. So this is an important piece of paper, the bill of exchange. Okay, and that's states what the transaction is going to be with regard to this shares being sold by this company. So once you have this bill of exchange, and this is something that can be drawn up even by the bank itself, so it doesn't require that citizens be lawyers who have to write these documents up. So that's going to be in this transaction here. So going back, okay, so I'm going to just read this. So before the loan is made, the lender, the bank, the risk insurance company, and other entities will first determine the feasibility, and we talked about that, of each loan. And that means the enterprise's new capital will be expected to generate enough profits to pay for itself. If it can't show that it's going to do that, it's not a feasible loan and it will not be able to sell its shares. And so it's kind of out of the picture. So it has to judge the soundness of the enterprise, the quality of management and workforce, its current and future markets. So that feasibility analysis, that even takes place before you can offer your shares. The bank, in turn, in exchange for this bill of exchange, the bank is going to issue back to the citizen through their account a promissory note for each capital ownership loan. Okay, and it's going to have a special checking account, and I assume this is the in the capital ownership account, or Mike can clarify that. So we call this process discounting, where the bank deducts from the total loan that's made a one-time premium for, it's administering the capital credit and a certain amount of profit for the bank, service fees, etc. So the difference between a service fee and interest charge is interest is charged every year or whatever period of time that you have a principal still owed. The amount you borrowed, it's going to get charged interest, until the end of the life of the loan, over and over and over. So this is just saying we've determined the total cost for getting this loan, and we can divide that total cost over the life of the loan itself, but it's basically one charge. Okay. Then the next step, this is where the bank is guaranteeing to the capital credit insurer that it will add a risk premium to the loan amount to purchase, because now, and the premium that's paid in the bank service charge It's all going to be repaid by the future profits generated by the corporation. Oh, I'm sorry. I just realized what I did. Sorry, Monica. I went. You had such a good idea that I stopped between every step. I kind of blew through that. So yeah. So why don't I pause, because I kind of went past where I was supposed to. So let me see the
Monica should be first.
okay,
Well,
Monica.
I did, and you know what? I had that hand up from before, but
Sorry.
is the premium charged every time there's an allotment or a loan or the COA gets an annual allotment? I don't know what else to call it. So is that premium is then taken out? It's not a one-time fee, it's a fee every time it's activated, I guess, right?
It's a fee on each loan. So there's only one total fee on each loan, but you're getting a new loan each year.
Each year, so there's a fee.
Yeah. So I don't know. Yeah. So did that answer your question?
Yeah, I just wanted to.
Okay. Yeah. No, it's a good question. John?
Yes, on the bill of exchange.
Okay.
A simple, I seem to be picking up. First, I was picking up, you keep calling interest free, but in your print, there is no statement of interest free each time you say it. It's interest free because the interest is as part of the bill of exchange. There's a comment in there about interest, how the interest will be paid off before before you have a right to get to your value. The debt and the interest are being paid off through the bill of exchange explanation. Yes or no?
No, I'm trying to see if we said anything about repaying interest, and I don't think we did. It's only a service charge. So yeah,
that's right. There's a service charge to
so let me see.
No, I know interest is not mentioned. That's why I questioned it. So I figure this is the point that it must come in about interest, because your whole notion is the capital account. Go ahead.
Okay, so that's a good point, is that somewhere we have to, let me see if I explain it somewhere else. Let me see, let's pay annually. Okay. Just double checking here whether our language is not clear. Feasibility.
Well, one of the main problems is that the science of finance sometimes uses indefinite or vague terminology and sometimes incorrect terminology, which has become embedded. For example, interest, strictly speaking, applies only to a loan of Strictly speaking, interest applies only to a loan of existing money. And this is why this is the main difference between a mortgage and a bill of exchange. A mortgage is an existing or past savings instrument on which interest is paid.
I understand that. Let me give you one example. I'm going to interrupt you because if I borrow for my insurance policy, interest is not paid at the end of the period. It's paid right up front. And I thought maybe you had a mechanism in mind to be like that.
Well, no, I would have gotten to that because they mix up the term. Sometimes the discount is referred to as imputed interest, and it's referred to that in the literature, but it's wrong. Now, the difference between a mortgage and a bill of exchange is that a mortgage pays interest. A bill of exchange is discounted. In other words, you have the bill of exchange, say it's for $100,000. The bank or the financial institution creates $98,000 if it's discounted at 2%. The borrower pays back the full $100,000. That 2% is the service fee, out of which the bank has to pay all its costs and see any profit, if any. And some experts or financiers refer to that as imputed interest, but strictly speaking, it is a discount, not interest. And it has to come from other funds. So that, and that discount is usually amortized over the life of the loan. It's not paid all at one time. So that, say you have 10 payments of $200 each for that $2,000. Excuse me, you've got $100,000 and 10 payments of $10,000 each. Of that, trying to do the math in my head here, $200 of each $10,000 payment is the discount because it's amortized over the life of the loan. So if you have 10 payments, then $200 of that making up the $2,000 discount. So it's not all paid at one time. So this is why some experts will call that an imputed interest, but it's not. Now, of course, for a standard mortgage, sometimes you will have, they say, pay the interest up front because we want to get it right up front. Or sometimes they'll say, and this is what caused the problem with the Dust Bowl in the 1930s when they had balloon payments of principal. All you paid over the life of the loan was interest, no principal. And then at the end of the term, you refinanced, which meant that you had to come up, if the loan was called, which it was in the 1930s, in many cases, people were screwed because they had to come up with the entire principal amount instead of having paid it over time. And I'm starting to talk too much on this because they can get into very technical, but
maybe on page 4, you might put in more information on the bill of exchange, imputed interest, but it's not interest, and this language, because I got stuck when you had bill of exchange and I put question mark, and you're telling me that there's more information behind the statement, and you keep talking about interest-free amount. So, and then you don't discuss where the interest is. So that clarification needs to be on step 4 or someplace. Thank you.
Okay, thanks. Yeah. So moving on to 5, this is the bank is saying to the insurance company that it will add in whatever risk premium, a one-time risk premium, to the principal amount that's going to have to be repaid. Okay. Step 6, okay, this is where the capital credit insurer insures each of the loans. So we have to have that capital credit insurance standing in place of conventional collateral, which means the assets that the borrower has that the lender can seize if they don't pay the loan off. Okay, so
I can't hear.
Oops. Sorry, am I
You're good.
Okay. Okay, so let's see, lost my train of thought. Okay, so as I was saying, capital credit insurance takes the place of traditional collateral, which is a barrier to most people being able to get loans for capital investment. Then the 7th step, the next step, is that commercial bank will bundle all the loans. Okay, it can either, I mean, if it went directly to the discount window and it has 100,000 loans, that's going to be rather cumbersome. So one of the practical steps is you may have a syndicator that helps to bundle all the loans that this entity is making in order now to go to the discount window of the regional Federal Reserve Bank. So the Federal Reserve, we're really talking about 12 regional Federal Reserve banks in specific areas of the country. Okay, step 8 is then, here we go, the bank is, and this is after it's bundled, it's going to the discount window of the regional Fed for rediscounting. Okay, so there's going to be another amount that's taken out of the total loan created so that the Fed can pay for its, labor, whatever its wages, salaries, whatever expenses it has for creating money. The next step, before I go, let me go on. Does anyone have any questions? I obviously need some practice in just taking questions.
I have a question.
Okay.
So when the rediscount happens, just like Mike explained, the 98%, that 2% is going on with the COA account and the bank. The rediscount at this part of the equation, how is who's
Okay, let's I'm gonna let Mike explain. The discounting takes place here, the rediscount takes place here. So Mike, do you want to give a fairly simple explanation?
The very first acceptance of a bill of exchange is called discounting. All subsequent acceptances of that same bill of exchange are called rediscounting. Now, we assume that the very first discounting or acceptance of a bill of exchange will be at the level of the commercial bank when the prospective borrower presents, his project, and it's either his or her, and it's either approved or disapproved. If it's approved, then they sign all the paperwork, and the moment the borrower signs on the dotted line on the promissory note, the bill of exchange is accepted and discounted right there. Now,
right?
If we have the 100% reserve requirement put in, and all qualified paper is immediately rediscounted at the central bank, the commercial bank turns around immediately and presents the bill of exchange, probably bundled with a whole bunch of others, to the discount window of the central bank. That's rediscounting, because what the central bank does is issue its own promissory note obliging the commercial bank on those bills of exchange. And it uses that promissory note signed by the commercial bank to create a demand deposit in the name of the commercial bank at the central bank. That demand deposit backs the new demand deposit for the borrower at the commercial bank level. So, and frankly, this chain, as what Henry Thornton pointed out over 200 years ago, can be endless as long as nobody breaks the chain and it goes straight. So that you can rediscount forever, as long as when that bill is redeemed at the level of the original borrower, that money that the borrower repays goes the whole way back to where the bill of exchange stopped, and then the redemption follows through. So that ultimately what the original borrower does is buy back his original bill of exchange after it goes through all those steps. In our system, we're saying there would probably be only 2 steps, from the commercial bank to the central bank. And then when the bill is redeemed, from the central bank back to the commercial bank, back to the original borrower. Now
so that 2% stays 2%.
No.
Okay.
The original discount can be 2%. When the commercial bank turns around and rediscounts it, that may only be 1% to the central bank. Because otherwise the commercial bank won't make any money.
I see. Okay.
And the central bank won't be able to cover its costs. See, each time something is rediscounted, the discount is smaller, because you're getting closer to the maturity date, plus the fact that each person along the way wants his profit. Otherwise, why would he bother to do it?
Okay. Okay. That makes sense. Okay.
Well, it's a little not.
No. That
Yeah. We'll
sense.
move on. Yeah, I'm not. The way Mike expresses is maybe we'll need to talk about making a little clearer, and Mike's covering it. I mean, he's describing the whole technicalities of the system in a short space of time. So if anyone feels overwhelmed, don't worry. So I often do myself. Yeah, but so we're just now giving giving you a structure. You can go back through these diagrams and ask more questions, but here this covered the idea of the issuing, the bank issuing a promissory note to, let's see, the regional bank issuing a promissory note to the commercial bank. So there's all along these chains, the same bill of exchange is backing all of these transactions. So if there wasn't a good deal between this and this, you're not going to have a bill of exchange to offer to the bank, who will then rediscount it here. So if this all sounds very detailed and confusing, it's simpler. We'll keep working on how to simplify this, but it's just so we have a logical structure. Okay, so then the commercial bank is going to take the money that was created by the regional Fed, and it's going to flow it through the account, and the account is going to buy shares from this corporation. So it's buying the shares and it's paying the money. And as we'll see in a second, the corporation, okay, writes out a check. So that's just the formality of how the shares are purchased. Writing a check from the account to the enterprise that is going to issue the shares to the account. It's going to take the money and it's going to use that. All right, as I just said, it uses the cash that it received from the account that was, ultimately generated here. It's going to take its cash and it's going to go out and buy whatever capital assets it needs. Okay. All right, and then as it's acquired all the capital and it uses it, puts it into operation, it's going to, this is the acquisition, it's going to then sell its new goods and services out in the market and generate new profits. Okay, and all those profits, okay, as it generates the profits, this is step 14, the enterprise makes scheduled payments of dividends. So it's, it has a certain amount that it's promising to repay each loan period. So it's paying out full dividends to the account based on the number of shares. And when it does that, the benefit to this corporation in paying out its dividends is it gets to get a tax deduction, okay, which is a very nice thing for the corporation. So the capital ownership account takes the payments from the corporation and it's going to make its installment payments to its lender. Okay, this is on the principal plus whatever portion of the service charge has to be repaid at that. And as I said, once that is paid off, the loan that this bank made to the capital ownership account, everything, the continuing stream of dividends is now income. This will get paid out of the account. Any dividend income will be paid out to the citizens. And then if they earn over a certain amount, they're going to pay personal income taxes. Okay. And step 16. Okay, so what we have here with the repayment of the loan, and the commercial bank has to make sure it pays off its promissory note to the regional Fed. And when that happens, the loan is all repaid and the money, and this is, Mike will explain this, it's really a bookkeeping procedure. That amount of money that was created is now canceled out of the economy. Now, that's not to say that the money that helped create the new capital didn't, it created new production, which the new production is its income. So, but that original loan amount is now taken off the books. Okay, and what that does is it prevents inflation. So in other words, you never have too many units of currency that are not backed by the new goods and services to be produced. So in that way, you complete the chain.